How to build generational wealth with life insurance. This is one of my favorite topics. I've actually did a 3-day event that actually created this, which is how do you build a legacy? How do you build generational wealth? Life insurance is a key part of it. So I want to talk about 3 things specifically today. The first one is the difference between term insurance, which we call death insurance, and whole life insurance. The second thing I want to talk about is how whole life insurance is the powerful tool. It is the tool to build wealth because it's an infinite banking system where you can loan against it and borrow against it. And the last thing we're going to talk about, the actual benefits and the costs of doing a multi-million-dollar life insurance policy. It's phenomenal. A lot of you are going to want it. You say, I can't afford it. You don't even know. So what I'm going to do today is I'm bringing in an expert of mine, a partner of mine. His name's Jason. He's an expert in insurance, and he will be offering some free sessions to talk to you more about your private situation, your generational wealth, why, what's your big goal, and see how we can help you. So let's go to the interview right now. So Jason, welcome to our interview today.
Happy to be here. Thanks.
So let's talk about, I'm going to say the obvious, but to many people, it's not obvious. And I think the reason it's not obvious is the amount of ads that people put on term life insurance. So the question is, what's the difference between term life insurance and whole life insurance? And maybe speak to it, why people spend, companies, Progressive, Geico, you name it, they spend so many ad dollars on term policies, not whole life at all.
Oh, it's unbelievable. And here's really the reason. Often people say, follow the money. The most profitable product for the life insurance companies is term insurance. The reason is,
I want to be clear, it's the most profitable for the company and the agent, not you, the individual.
That's absolutely right. Thank you for making that fine point. It is the most profitable product for the company. The reason is less than 1% every payout. People have it. You're renting for a term. That's why it's called that. Think of it kind of like renting an apartment, right? And you sign a 1-year lease and you pay your rent every month faithfully, and you get to the end of that lease and you decide to move out. What do you get back? Do you get back any of your rent? Well, heavens no. The same thing with term insurance. You rent it for 10 years or whatever, and you have a nice death benefit. That's the only benefit you have. Yet when you get done investing for that death benefit over that 10 years, you have nothing left, absolutely zero. Whole life, on the other hand, and there's a lot of confusion out there when they use different names of the different products, but we're talking truly whole life insurance. It's kind of like owning a home, right? It builds cash value over time, and it gives you the opportunity to have more and more benefits during your lifetime. I said this in the last interview that we talked about episode. Life insurance, true life insurance, not death insurance, should have 3 components. Number 1, there is a death benefit. Number 2, it's a deferred asset. And number 3, it's a current asset. Term insurance only has one of those. There's no real current asset to you. There's nothing that you can use today to help you in your financial journey. And the other thing is, you want to have whole life insurance from a mutual company. And that's probably why some of these mutual companies, they're severely restricted by the government as to what can be said about them and how they can be marketed. That's another reason why you hear so much about term. There's not the restrictions that there is on whole life.
So I want to just clarify, you said it's a current asset and deferred asset. Again, a lot of folks that are here on our YouTube channel don't know the difference. So when you say that, kind of deepen that understanding.
Like I said, you're getting equity inside of your contract. You're also building up, when it's a mutual company, you're also building up ownership of the company. So it puts you in line for your portion of the company profits. Insurance companies are very profitable. How much of that company do you want to have like preferred stock of, right? So in a long-term sense, being a deferred asset, when you get older, get to passive income time, which I like to call it instead of retirement, you can then have those dividends come to you as income, and you'll never outlive your money, basically guaranteeing to yourself that you will never, ever be poor. The other thing is, a current asset is something that you can use today. Can I go help finance a car purchase today that's more advantageous to me than going to the bank or a financing company? I like that idea. It's something I use today. We always say, Loral, you and I say it all the time, we believe that you should be the first beneficiary of your life insurance policy.
Yeah, absolutely. Jason, let's move on and talk about how that whole life insurance policy actually can help somebody build wealth. You've talked about it a little bit in the current, but give some examples. Like once you have it, how could someone really use it as a bank, lend against it to build other assets like real estate? I mean, you could build an entire real estate portfolio off a life insurance policy if you did it right.
Let's say, for example, that you have been contributing to a policy for a while, made several contributions, and you have built up your cash value, say 100,000. And you find a pretty cool property that you want to do a fix and flip. And you go out and find a contractor, they give you a bid and say, yeah, this is what it is, and it seems reasonable. So you take a loan against your policy, say $20,000, and engage that contractor. Well, month after month after month, not much has happened. You're into it 4 months and the only thing you have is some framing in the basement. Well, you get rid of that person and then you find someone new and it goes good. And you go, say, another 4 or 5 months, a total of 9 months. And then you sell that property and you make a profit. Well, in the process, you've taken more loans against your policies. But guess what? You haven't had to be making payments every month to the insurance company for the fact that you're in control. Had you borrowed that money, say, from a hard money lender or someone else, you would be needing to make at least interest-only payments. In this scenario, you're not having to make those. And so it's a lot less stress, right? And it makes it a lot better because you're at a better interest rate than you'd ever get from a hard money person. Yet you have the ability to then build the property, rehab it, sell it off, and then replenish your cash values, if you will. Or the same kind of thing might be in financing a car. When you purchase a car using your policy, you're paying interest, yes, to the insurance company. However, remember, you are a part owner of the insurance company. All interest that goes to the insurance company is profit to the company, and you're a part owner. In other words, you get part of the profit. It's not paying interest to yourself. You're paying it to the company, but it is kind of coming back to you for the fact that you are an owner, right? The other thing is the flexibility here. I already kind of said that with the story about refixing it and flipping a house, right? The flexibility to not having to make regular payments every month. Let me tell you a story. My son, Scott, needed a car. He's right out of high school and needed a car. He was going away to college. And of course, Mama wanted him to come home and visit occasionally. And I said, okay, go find a car, go see what kind of terms you're going to get. Well, he was coming back 10, 11, 12% for the fact he really didn't have much of a credit score. Had I learned about your teaching sooner, I would have been better off. However, so when I looked at him and said, look, I will finance this car at this interest rate because I have a policy on him. And I took a loan against the policy and I financed it to him. To the dealer, it looked like we paid cash, but I financed and he started making payments to me. Okay, so he goes August, September, October, November, even December. He did good, made his payment every single month. He was being a good guy. Well, come January, he calls me. He said, Dad, I can't make my payment this month. I said, what do you mean? I said, well, last month was finals, semester was in his finals. Then I came home for Christmas and yada, yada, yada. I didn't work as much. I'm unable to make it. The payment on my car this month. Then I had a teaching moment with him. Had we financed this from a finance company or from a bank, your credit is, whatever credit you do have is completely shot. And there's a good chance they're coming to repossess your car. In this scenario, I was able to say, no problem. Your payments will go on another month than what we originally agreed to. Just make the payment next month. Made the payment the next month. We go 2, 3, 4 months into it. Of course, he took off and did summer sales and killed it. And when he got his money back, he said, I don't like paying you interest, Dad, and paid me off. It was phenomenal, that flexibility. In the meantime, like we talked before, his policy was compounding on the gross amount of his cash value, not on the net, the gross minus the loan. It had grown quite a bit. And when you actually get a policy that's developed and has been aged, the interest that you're going to be accumulating and the dividends you're going to be accumulating is a really good chance that it'll be more than the interest you pay to the insurance company.
Love it.
Another thing is you have to think about this as a long term, right? The very, very wealthy families, one of the very first things they do when a child is born is they buy massive amounts of insurance on that child for the fact they know that when those policies are enforced, the longer they're enforced, the more efficient they are in accumulating cash and building.
Love it. So before we talk more about the cost benefit and some mistakes that you need to avoid, costly mistakes, subscribe to the channel if you've not done that so far. Click that notification button. We want you here 5 days a week. Again, it's family-friendly channel. And grab our journal. It's in the description below. You can also meet Jason again on our Millionaire Intensive. There's 2 tickets to that in the description below, as well as he and I have an amazing free gift report about insurance in the description. So lots of free stuff to go grab in our description below. And let's go back to our final piece of information for this video. And this time is the cost benefits of a multi-million dollar. Like if you had $1 million policy, what are the benefits of that?
More to play with, more cash value to play around. Let me say, if we take a 45-year-old male, standard health, average health, and we want $1 million death benefit. Now they're going to invest roughly $3,900 a year for that. Wow, that's good. That's nice and cheap. I can make that happen. If I die, my family's going to have $1 million. Well, you do that out over 10 years, you walk away from it. That means you've, put out close to $40,000, right? You get none of that back. On the other hand, in the event you were to do a whole life policy that's designed for cash accumulation, you're looking, call it $42,000 annually. Oh, who would want to do 42,000 when they can do 3,900? Here's the thing. You go out 10 years, in the event that it's designed right, and you decide, I don't want to do this whole life anymore, you're going to walk away with every penny you put into that. You just shut it down, cancel it. Your cash surrender value is going to be equal to and possibly slightly more than the total premium you've paid during that time. Holy smokes. Talk about the benefit. Really, what's the cost? Is the cost the monthly or the cost over time and then what it does going forward? But the fact that whole life, you keep it and you keep going, it's building and building every year, guaranteed. There's not very many things out there that are guaranteed, not to the level of guarantee that you can get from a company that's been in business, over 100 years and been paying a dividend, 120, 130 years consecutively. Whole life insurance also gives you some tax advantages. Once it's inside the contract, it's growing tax advantaged. And it's a secret that most people don't know about. The wealthy know about it. And there's another thing, Laura, I'm not sure I've ever told you this. There was a time when I actually wrote a chapter for a book, and it was called Get What Congress Gets. And so what my task was is I went out and I went through all the public filings of every member of Congress, both the House and the Senate. I looked at the Supreme Court judges. I looked at the top players in the cabinet at the time, the executive branch. The longer they had been in Congress, the more they had in cash value life insurance, more they had the actual cash value. And then, in fact, Anton Scalia, when he died, he had $1 million loan against his policy, which tells us his cash value was way more than $1 million.
Yeah, and those of you who don't really understand the compounding power of money, go grab a compounding calculator. I always love that simple activity, Jason, and just play with it. Like, how much are you going to put in? How much would you add a month? And just play with what compounding and how fast you can double. Rule 72 says you can double in 7 years. We know with our strategies and what we do, we can get it down to, I'd say 3 to 5 years in doubling, but you've got to start early, and the faster you start, the better. So again, grab our report in the description below. Inside the report is a Calendly link for Jason, and you can get on his calendar to talk one-on-one privately about your situation. If you have any questions, go to askloral.com, ASKLORAL, ask a question, make a request. I'll be back tomorrow. Thanks, Jason.